Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Tech concerns continue to weigh on equity markets worldwide. Alicia Levine of BNY Wealth writing, "We do not anticipate macro downside and so expect the market to rally into year end. The risk is to the upside from here." Alicia joins us now for more. Alicia, good morning.
Good morning.
You said that last time. What's gone wrong in the last few weeks?
Well, I don't think anything's gone wrong yet. I mean, if you think about it, the S&P is off about 5%. Really, it's the tech stocks that took the hit. But what's interesting, we talked about how high the multiple was in the S&P at 23 times. We're now at 21 times. So the market's done a little bit of work here to take some of the froth out. In the end, we're always looking forward for our client portfolios 12 to 18 months forward. We think this will be a buyable moment. Where it ends, there's going to be, as you said, the next 24 hours gets to all the issues, gets to the earnings, the spending, the depreciation issue on how the P&L is being managed for all these tech companies, which has come up in the last week, as well as what's happening with the labor market, as well as what's happening with the lower end consumer. So you're getting all these issues answered in 24 hours. And I just think that market participants did not want to carry risk into this. It's just too big because you are getting the macro story as well as like the micro of what's going on with this particular trade that has driven the market for the last 18 months.
So Alicia, let's unpack some of that. So we've got a big morning tomorrow, Walmart, and we've got jobs as well. So that should give you some indication, a little bit at least, of what the Fed might do next month. I want to sit on Nvidia. As a company and as a stock, as a company, the earnings should be pretty good because we've heard from their biggest customers, and their biggest customers want to spend more and keep spending more. So I've got that sorted. As a stock, there's an attitude shift that's developed in this market. The things we used to rally on, we don't rally on anymore. What's behind that, and why do you see it changing?
So look, the big difference here, and you know I can't talk about particular companies, but this is a theoretical, this is the
entire market itself.
The entire market itself is that the debt financing versus financing from equity or financing from cash flow is the biggest change, and it does introduce a different risk metric. So to me, it does make sense that you're bringing the multiples in a little bit simply because if you're debt financing, that is a different kettle of fish. In the end, we've talked about how the margins are so high, how the cash flow margins are so high, particularly for this sector, that it's able to sustain higher multiples. If that is the case, that in this new world, you're going to compress some multiples here if there's debt financing. So that's the big change here. The tech sector, as a standalone, has already dropped, 2 turns of multiple as well, from 31 times to 29 times. So there's been a lot of work done here. I think it's a reset because I think we're in early innings of this. I also think it's healthy that there are larger questions asked. As we look forward, we expect consumer stimulus coming from the tax code, February, March, and April, as refunds to households, the lower-end households. I think you're going to get a broadening out here, in part because of the questions about how this money is actually getting spent. And in the end, as we know from 25 years ago, there are winners and losers. We've not asked ourselves that question as a market, and it's almost impossible to know. It's impossible to know. So, the companies that are the behemoths today were like, a gleam in an eye of some college kid in a basement, back in the late 90s. So it's hard to know how this is going to get monetized. But the questions are being asked. I think the questions are good questions. You don't want a straight upward move in the market. So this, I think, is healthier.
Although, as an investor, if we're in the early stages, how do you pick the winners for even the mid stages, right? And it sort of goes to the heart of, do you just hunker down down with the big tech names that are the big tech names today and generating cash? Or do you bet on the evolution of AI to the rest of the index, the idea of other potential winners in this potential race?
So I think part of what we're seeing here is that evolution from sort of the picks and shovels and the direct beneficiaries to implementation into business strategy. And you're starting to see it in some of the industrials, and you're even starting to see it in the hyperscalers. Like if you just look at some of the revenue per employee for some of the hyperscalers, it's gone remarkably higher since ChatGPT was released. So there's already implementation. The market is going to start picking the winners and losers in the other 493. And that's what we're going to see. That is a healthier place to be. If you're changing your business model, what we know is that the overall margin for the S&P continues to march higher, separate from the top 7 stocks. That means productivity is increasing, and it's likely because there is AI being used across the value chain in many, many companies. Whether, if there's data as part of the company, it's being used.
Well, one thing that people keep saying is that all of this is predicated on enough energy to power it. And increasingly, a lot of the hyperscalers are realizing, oh, no, we don't have that. So we have to come up with a backdoor way off the grid to try to power our sites. I just wonder at what point you can invest in the energy sector, or whether it's hamstrung between policy and politics, between Saudi Arabia and President Trump and the potential agreements on oil.
Right. So, look, there are no accidents here, right? I mean, I think that part of the new administration, well, that's not new anymore, but part of the Trump administration's policy was to keep a lid on energy prices, and that is exactly what's happened. We're sitting at $60 on WTI, $64 on Brent. That's exactly what the policy has been, and I think it's no surprise that bring energy down to drive all of the innovation. In the end, it is a competition with our, adversaries out there, and so this is part of the plan. There will be questions asked along the way. The expression is wiser but sadder, sadder but wiser. We are wiser about technological innovation than 25 years ago. We understand there are bumps along the way. What I see is a remarkably resilient corporate sector. The productivity is going across all sectors. We will see it. The margins are higher. And so we can ask questions about debt financing on the top 7 stocks. We got 493 that can also power the market. And I think as a business, we are raising our earnings estimates for next year and for the following year into this. So we believe in the productivity. We see it. We see it in earnings estimates. Yes, some sectors are coming down, like communication services, because of the spending of some of the hyperscalers. But overall, we're raising estimates.
Do you think there's some scarring from .com? The issues that we saw then have conditioned a certain group of investors.
100%. The way we've had scarring from GFC, right? Like there's scarring there about, is this a bubble? Well, we're up 100%. It's not, a great colleague of mine sent me a bunch of charts on like what previous bubbles look like. We're just like a tiny little speck, right? The appreciation in the market and the particular companies at the heart of this are actually exhibiting a shallow rise in compared to what we know were bubbles in the past. We think we're actually early to mid innings of this, and there's a way to go. The fact that the market appreciated for 6 months in a row, 7% in the third quarter, and we're quivering over a 5% downdraw just tells you how great a year it's been. And there was broadening out. And I think, look, we have to get the Fed question also. Like, Is the Fed going to cut? I think the chair has been very careful to keep the probabilities at 50-50. Even though we've had hawkish comments, the market's not pricing in anything less than 50-50 on the chances of a cut. And that's done for a reason, because they want optionality to cut.
Let's finish on this. What's a good number tomorrow morning on payrolls? I can tell you the estimate in our survey. It's 54. What's a good number for this month?
I think anything over 50 is fine, right? Because the 3-month rolling average is 29, and that's pretty awful. So anything that pulls, so I think 50 is fine. That will change the probability of whether we get a cut or not also in December. I think overall you'd rather see a stronger economy and a better labor market. So I think that's important. I think NVIDIA, we'll have to see what the earnings are. But like you said, the hyperscalers are spending. So that's, I think, more knowable than not. And then ultimately, for the largest retailer on earth, half of the American population is a customer. So we'll see what half of America is doing.
And the other half thinks they're Group 1 at the airport. That's the US economy right now. Alicia Levine of BNY Wealth. Alicia, thank you. Stay with us. More Bloomberg surveillance coming up after this. Let's turn to the labour market data. Investors eyeing the long-delayed September jobs report due tomorrow. Francis Donald of RBC writing, we think fourth quarter data will likely add more confusion than clarity. Francis joins us now for more. Francis, welcome to the programme. If we're going to be more confused than clarified, what does that mean for that decision on December 10th?
Well, it means the Federal Reserve is going to be more confused and clarified. And the Federal Reserve, just like markets and economists, are going to have to think a little bit further out into what Q1 and Q2 are going to look like. And probably that tells us that employment will become slightly more problematic, not dramatically, and inflation will continue to rise. It's a continuation of that stagflation light type of environment. And even if we have a bit of a hole here in a couple months of data, looking through, our view is still the same, which is growth is going to be slightly below comfort level and inflation is going to be slightly above. And that will be the situation that this Federal Reserve and future Federal Reserves will likely continue to have to deal with.
What are you looking at to confirm that view? We know that September data is going to be backward looking. Yes, we get that tomorrow. We know that October data is going to be muddy at best, confusing at worst, and potentially might even distort the picture further because of the government shutdown. And it's unclear what CPI data we're going to be getting. So what are your benchmarks right now?
You know, we definitely have enough on the job side from a variety of private sector data in order to give us a sense of the momentum. Do we know the exact level? No, but we know it's sort of soft, stabilizing, enough to bring us towards our forecast to an unemployment rate of about 4.6 later into 2026. So that in and of itself, we can see the big problem is on the inflation side. That's where we have really minimal perspective. We don't have the ability to see much of what happened in October, and we're probably not going to get full clarity on what that level looks like until early in January. And actually, you don't even get the January data until February of that month. But I think one of the stories here is that we get so obsessed with month-over-month data as if we need to see what happened last month or 3 weeks ago to know the trend of the economy. And the truth is, we don't. We actually have the ability to map out over an extended period of time. That's why economists have 1 year or 5 year forecasts, because if we know the direction, we can make various assumptions. And our assumption is that we have not seen the inflationary impact of tariffs as of yet. We are still drawing down on inventories in the United States, and we're likely only going to start seeing that real pressure on inflation in early 2026 and in the middle of 2026 going forward. So we can maintain those assumptions even if we don't have week-to-week maybe obsession over what the exact level will be.
One thing that a lot of people said during the pandemic was listen to the companies. The companies have the front view in terms of how to plan their businesses. We heard from Lowe's, we heard from Home Depot, we heard from Target, kind of a motley picture here. Are you getting a sense from the retailers, from the consumer-facing companies of a picture that gives you more clarity heading into 2026?
Absolutely. We're looking for anyone who can give us information. I might add things like the Fed's beige book into that story. So some of the anecdotal evidence that some of these core themes are coming through. The big thing we're seeing really now accepted in the broad-based narrative is something we've been talking about for well over a year now, and that's that concept of the K-shaped economy. And while I think there's still maybe a little bit of a view that that just means the haves are getting richer and the not-haves are getting worse off, I don't know that we've really internalized how this is changing the dynamic of consumer spends. That we've got some consumers that are trading down, and that benefits some companies, and we've got other consumers that cannot trade down at all. It even flows into conversations of, for example, potential $2,000 checks to American households. Will that be inflationary? Not for the lower part of the K, who are still really struggling with affordability crises. So we're looking for sort of evidence of what the shift in the consumer is really doing. And I'll add on top of that, it's not just a K-shaped economy, it's also an increasingly retired consumer. What are those spending habits looking like? Because this is really a consumer that we haven't seen for many decades in the American economy, and any type of anecdotal or hard data that we can get on it is very helpful in constructing that narrative and helping companies navigate an increasingly difficult operating environment.
Francis, I don't expect you to get deeply philosophical when I ask this question, but just to take a step back, what has gone wrong in the West? Why do people hate these economies so much? Because it's not unique to America. I see it across Europe as well. What's gone wrong here since the pandemic, and what can we get right?
Well, when we look at the data, which is the economist's perspective to the philosophical questions, what we see is really a break in 2023. And it comes back to this perspective that historically, while, the wealthy spent more than the not wealthy, most of the economy followed the same economic cycle. So if your upper incomes were doing well, so were your lower incomes. It was tides that lifted and sunk all ships at the same time. So even though maybe some had more than others, it really felt more egalitarian that we're all sort of following in the same economy. After 2023, and that's where we see the data really start to break down, that's when we see that the haves, or the upper part of the K, are really experiencing an entirely different economy and a different economic cycle. And this is, I think, the biggest question for the Federal Reserve. It's not who's going to be the chair, is that how does policy act in an environment where interest rates impact everybody at the same time, but some areas of the economy require different interest rate policy? What about things like fiscal policy has to become extraordinarily more targeted? My concern heading into 2026, if you've asked me to be philosophical, is maybe that lowercase k becomes even a uppercase K, because we're going to see things like changes to the SALT cap deductions. That's going to benefit the upper part of the K. Financial markets doing well benefit one side, and we still haven't seen any material relief on the affordability side. So when I talk to clients about the K-shape, they say, well, what solves it? And my answer to them is you should really think about this as maybe semi-permanent type of dynamic. It's not going away anytime soon. And if you're a company trying to figure out how to service your clients, you have to be really, really aware of what part of that K, or maybe we should increasingly call it a fan, you need to be looking at.
Stay with us. More Bloomberg surveillance coming up after this. Here's the view on Wall Street so far this morning. Julian Emanuel of Evercore calling for the S&P to hit 7750 by the end of next year, writing the path to a bullish long term is often a series of volatile, uncomfortable short terms. This is one of those times. Julian joins us now for more. Julian, good morning.
Good morning.
Things have changed. Why have they changed? What's behind this recent shift, the way the market treats this story?
It's actually the debt concerns, in our view. Again, because, and this is inescapable, and we've talked about this a number of times throughout the year, you cannot get away from the comparisons to the late 1990s in many respects. And when you think about the late 1990s, the problem with the bursting of the bubble, besides the fact that the Fed was hiking in 1999, was the fact that a lot of the build-out was financed by companies that were incurring debt and had no revenues on the other side. And because you've seen this accelerating debt issuance, there is the worry that that is coming back. And we would say that's actually a good, rational worry.
Well, and it's a worry potentially to buy. I mean, I guess that this goes to the question of what makes you so bullish on an ongoing basis, despite some of the rhyming features of this particular rally with respect to the debt component?
Well, so a number of things. Again, the macro backdrop is favorable. Okay, the Fed is going to be cutting. We're going to have more stimulus, whether we get $2,000 in our pockets at some point next year or not. We're going to have more stimulus. And from a valuation perspective, as much as angst as there is, in fact, certainly in comparison to the late 1990s, these names are, I wouldn't say cheap, but they're certainly not expensive relative to history, and they're not expensive relative to their own history. And what we've seen over the last several years in a lot of them is they just mark time going sideways, so earnings catch up to valuation, and that's an ongoing process.
At the start of the sell-off, at the start of November, it was very much what you're talking about, a realization of the debt component. It seems like the tone has shifted over the past couple of trading sessions to not just a tech story, but to an everything story, raising questions first about whether the Fed is going to cut next month, and second, whether the U.S. economy is strong enough to withstand some of the optimism without that rate cut. How much do you see that story continuing? The idea that maybe the weakness under the hood is part of what's pushing this story as much as the debt overlay to artificial intelligence?
Well, a lot of it is the fact that we simply haven't gotten data for the last month and a half. And, in the beginning of it was okay, fine, the markets were doing well. The uncertainty is a positive, but then investors realize that uncertainty is uncertainty and should be discounted. Our suspicion is that over the next number of weeks, as we get back to normalizing the data releases, people will at least have something to anchor on. And the question in terms of the economy, and which is certainly the question that's the backdrop for sustaining these valuations and, of course, monetary policy, is the economy okay with the slower speed of job growth? We think the sort of the monthly break even is somewhere between 30 and 60,000 jobs. Is that palatable? We think the answer ultimately will be yes.
Julian, forgive me, it's almost like we've forgotten what it was like when we had the data. When we had the data, people questioned it all the time. They questioned the quality of it. They didn't like the payrolls data. In fact, the payrolls data was super weak, even if you believed in it. And I don't know how relevant the equity market story was to the payrolls data we've seen over the last 7-8 months anyway.
Well, we have never put stock in the monthly payrolls data. It's the weekly jobless claims data that's always been high frequency importance, and we've been sort of calculating it back of the envelope at Evercore ISI these
Anything
last
to worry
number
about?
of weeks. No. It's, steady as she goes, 230,000 every single week. And I think once that becomes transparent, we're going to see that again.
Does it come down to this? The stock market, what it really wants, the earnings story that it's already got, but it wants the rate cuts too. And to get the rate cuts, you need the weak jobs data. Is that what it comes down to?
Look, at 26 times, you have to have constant positive narrative. Stocks are expensive. Stocks being expensive is not a reason to sell the market. It can be a headwind, as it is at the current time when you have this uncertainty. But again, ultimately, to your point, John, is that earnings revisions are just phenomenally strong. The runway to next year in terms of earnings growth is great. And as I look at it, our 77.50 price target is likely not going to imply any multiple expansion, which makes me want to mop my brow in relief.
Well, mop your brow in relief or put a higher multiple on the idea of bubble territory. We're on bubble watch, or maybe bubble call, or whatever you want to use the word, B word, that everyone seems to be overusing these days. What would it take in terms of Fed rate cuts to get to your extreme bubble call, full bubble, which you put at a 30% chance currently for next year?
You'd probably need 4 or 5 cuts in an economy. Well, look, back it up. The fact is that in the last several weeks, both the trajectory for growth and the trajectory for inflation appear to be improving. We took our number down to 2.7 on core PCE for the end of next year. That's certainly going to be sufficient enough for the Fed to cut. We took our growth number up to 1.9. And frankly, the way the setup is right now, there could be upside to the growth number and downside to the inflation number.
Stay with us. More Bloomberg surveillance coming up after this.
Can you persuade Americans to save that $2,000 check?
Good luck. How would you persuade them? You're going to get a sale. You'll get a Birkin bag in December.
Seriously.
Yeah, honestly, try that with kids.
$2,000 getting spent almost immediately. Libby Cantrill of PIMCO has this to say: we're very skeptical the Republicans in Congress at this point are interested in adding more to the deficit with another tax cut. Libby joins us now for more. Libby, good morning.
Good morning.
There's a shift at the White House. Affordability in focus, new initiatives. Where's this shift coming from, and is it durable? Is it sustainable into next year?
Yeah, well, yes, there is a shift, and obviously it was precipitated partly, at least, by the election 2 weeks ago, when Democrats, if anybody who had a D, on the end of their name, basically did well, and most Democrats did run on affordability, probably in some ways learning the lesson from 2024, where they didn't sort of lean into that issue as much. And so now the White House, I think, understandably, a little bit like how President Biden did in 2021 and 2022. Maybe in vain, is trying to shift more to affordability. I think there are obviously limitations to what the president can do unilaterally, and I think Secretary Bessent understands those limitations. You do need Congress in order to cut taxes, even if the revenues that are going to offset that tax cut would come from tariffs, which obviously were put through unilaterally. So we are skeptical. Now, with that said, and this is something we think that the market is obviously focused on, is that there will be a really nice, healthy healthy tax refund come next spring. I'm not even sure Americans actually realize that they're going to get such a nice refund. But, on average, households will likely receive $1,000 kind of plus, sort of depending on their tax bracket and their tax situation. So that could maybe, have the same effect. But in terms of an additional tax cut paid by tariff revenues, we think it's very unlikely.
What do you think is on the menu? So we've seen some tariff relief already. We've seen the prospect of a $2,000 rebate check. We've also had a conversation about 50-year mortgages as well. What else is on the menu?
Yeah.
What other proposals are?
So, obviously, the reduction in tariffs for foodstuffs, for beef, for coffee, for bananas, a little bit of a tell that maybe tariffs do raise costs, at least incrementally. And then, obviously, the 50-year mortgage, we again, skeptical that actually goes through. Lots of issues with that. Maybe provide some upfront affordability, some cost savings in terms of mortgage payment, but obviously reduces the amount of equity that folks are able to build in their homes. Is not TBA eligible, to be very wonky, so probably has a liquidity issue as well. So I think the upshot is that we think that's unlikely. Of course, the real issue with housing, as we all know, is supply, and so trying to incentivize developers and folks to build, that probably takes Congress as well. And there's some things that they can do from a permitting perspective unilaterally, but really difficult even on the federal level. So I think the upshot here is there just limits to what the president can do unilaterally. He can talk about it, but he probably needs Congress to do most of it.
But what we learned from the midterms, and I'll call them the midterms, because it's essentially what they were, is that there is this shift to affordability, and there seems to be bipartisan support to really help consumers with the cost of living concerns that they have. It is a bipartisan issue politically. Why has the vibe shift not moved into materially higher long-term yields if you have bipartisan support to reduce the amount of tariffs, to reduce the amount of cuts just broadly to government, et cetera?
Yeah, it's a good question. I think we've obviously, of course, as you all know, the curve has obviously steepened a lot over the last year, and so it still remains relatively steep, at least relative to the very kind of flat yield curve that we had seen, for years previously. So in some ways, that term premium has come back a little bit. But there still is a bid, obviously, for treasuries. There's, we always say the kind of the cleanest dirty shirt. This expression of Bill Gross's, our founder at PIMCO, used to talk about kind of there is no alternative. You have a lot of dirty shirts. You wear the cleanest dirty shirt. Doesn't look great on an absolute basis. Looks good, pretty, relative to the other shirts. And I think that still stands. So, there is going to be some natural limit in terms of how, at least right now, how high the 30-year, how much that term premium does expand. But all things equal, if you just go back to where we were back in, October of last year, the yield curve has steepened. Yeah,
I just wonder if bond vigilantes have either gone to sleep or never existed, right? Because at a certain point, we're talking about the deficit that at one point was the rallying cry for people who are saying yields are going higher, and all of a sudden we're looking at the potential rollback of tariff revenue, the potential addition of policies that could potentially support consumers, whether that $2,000 gets passed or not. Yeah. You're talking about a bigger deficit. Suddenly nobody cares. What's the deal?
Yeah, and we've been talking about kind of the 6-7% deficits really for the foreseeable future. I have teenagers at home.
Well done, 6, 7.
But really over the foreseeable future. And that was our view going into this, that regardless of who won the election, the deficit would be the biggest loser. That has obviously come to pass. And nobody is talking about sort of fiscal responsibility. They're not talking about increasing taxes or changing entitlement spending. And that's really what you actually would need in order to change the fiscal trajectory. But the same thing, just from an investor's perspective, people are looking at the U.S. as the sort of source of growth, right? If you just look at what's happening, obviously, with AI, with labor mobility, still immigration, the dynamics of the U.S. economy are still much more attractive than the other developed, rich world. So I think there is a little bit of that where there's just going to be kind of demand, at least as of now, for our debt because of those dynamics.
I cannot believe 6-7 made it to Bloomberg.
Sorry about that.
It's okay. I think that it's great.
And Libby Cantrill made it happen.
Honestly,
my kids would be so proud.
You made us relevant because right now that is ultimately relevant.
Farming.
Yeah, exactly.
Nice. Okay. Let's not take this too far.
I'm going to get an email from our PR people.
Where is Libby taking this? I think PR at PIMCO are confused already. Libby, I want to finish on maybe a fracture in the Republican Party. Congressman French Hill was on the program a little bit earlier this week, and he made the point that he didn't like broad-based tariffs. And he's typically very diplomatic, but I think a little bit more vocal now. We're starting to see signs of the Republican Party on the Hill. It's pushing back a little bit to the White House. Are you sensing the same thing?
Yes, obviously the vote on the Epstein files was a little bit like that, just sort of put the exclamation point on that sentiment. I do think that, and this is actually a bipartisan phenomenon. If you just look at the Biden administration, at the end of 2021, the coalition around Democrats was fracturing then as well. So there was more pushback on President Biden by his own party. I think the same thing is happening now, right after the off-cycle, the midterm election of 2 weeks ago. You are now seeing that political runway for the president shorten. And again, this is, I think, pretty consistent with history. But I do think you will continue to see more pushback. And as it relates to fiscal policy, tax cuts, adding to the deficit, a lot of Republicans very uncomfortable with that. I also think it has implications for the Fed chair in terms of who's actually the nominee. You may see, if the president were to nominate somebody who was viewed as not independent, was viewed as too political, I think that Republicans are increasingly feeling a little bit more comfortable to push back. They have been privately, but maybe more publicly as well. And again, pretty consistent with other cycles in history.
Do you think, just finally, that could lead to a sensible Fed chair choice?
That has been our view. We think that there's going to be a much more conventional, orthodox Fed chair than I think a lot of people at least feared in the market.
That's what sensible is to me.
That's
right?
to me, right? That's exactly.
He would be the easiest. He would be the easiest.
Who do you think the president believes is politically correct? What does that mean to the president?
Yeah, not sure. But I think probably somebody who's more familiar to Washington. So whether that is Governor Waller or Kevin Hassett, somebody who's going to be a little bit more familiar.
Seems like different characters. I don't know.
Very different.
6, 7.
Libby, good to see
7.
you. Oh, nice. Okay. Aura farming again.
Or farming over
nice,
here,
just
guys.
Overwhelming. Okay.
I'm never getting invited back.
Libby, you'll be invited back. Thanks for being here. Libby Cantrill at PIMCO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.